Good morning, everyone. Welcome to the Trading Market Technicals morning call video for Friday, April 5th. Green across the board yesterday. Dow up 55, Nasdaq up 5, S&P up 6, dollar down ever slightly, about 4 cents, and gold had a nice bounce, up $10 on that oversold reading that we were talking about, the bullish percent gold miners index. I'll look at that in a moment. Very quiet as far as the market is concerned for the last couple of days. We did have that one down day where I was not here, and then yesterday we basically was a chop session. I think what's happening is that a lot of market participants will be hedging against non-farm payrolls for today. And just quickly noted, non-farm payrolls will be out at 8:30. We have consumer credit coming out at 3 o'clock today, and then we have February trade balance as well as coming out at 8:30 too. So keep in mind, non-farm payrolls have been quite subdued the last couple of months. Announcements. However, this could be a pretty big game changer for trend since we're so elevated at these levels. And initial jobless claims weren't so great, so we've been having this trend of economic data have been mixed. So it's very interesting to see what's going to happen here at 8:30. And there'll be a good hour to digest what the markets are going to be doing, and if the markets are going to be headed north again, or do we get some sort of a trend change. And usually, the non-farm payrolls really dictates the trend for that month, but the last few months have not done so. As we can see, we continue to go higher, and we did have some good numbers anyway. But nonetheless, we are continually holding these areas here at 1559, 1560, and we're just at these record levels with no sign of a pullback in sight because there's really no catalyst. So we have to trade accordingly at what the market is giving us. Now, there are tons of red flags. I'm not going to go over all these indicators again because really nothing has changed. I'm just going to show you a few. And this in front of you is the S&P 500 percentage stocks above the 50-day moving average. And as you can see here, clear-cut divergence from what the market price is doing versus stocks above the 50-day moving average. They're actually selling off, going lower. So speaking of that, let's take a look at the new lows. New York Stock Exchange 52-week new lows. And when you get real big spikes like that, that's where you has produced some sort of a market bottom. But if we're in this area here of 40, 50, 60, the market usually absorbs any of the new lows. So right now, this indicator really isn't telling us much. There is a little bit of a spike above 60, 70, but we really need to get above this area here. Really need to get above 60. And we need to hold and start spiking in this area. It's sort of like something like what you see here, like lots of spikes in this area from 60 to 100, 110. Then you could see that this indicator will be indicating to us that we have selling coming into the market. Right now, when you just have rotation, it's really not going to tell you much. So this isn't really doing much of anything, but it's just something to keep an eye on when we get highly elevated at these areas. VIX did have a down day from the previous up day we had, and that's what we've been having, right? Price action has been going up. Next day's been going down, up, down. When you have this choppy movement in these levels, it looks like that the market is trying to carve some type of a tradable top, at least for some reason. But we'll keep an eye on it. But the VIX really didn't do much, down 32 cents. This is the CBOE option total put call ratio. This actually closed a little bearish yesterday, and it looks like to me this is all of this. All this is hedging. Really not much fear, but it does gauge people buying puts. And it looks like this probably just hedging against their portfolio. But again, we'll see if this starts to continue and starts to spike back up above 120. Then you're going to have a reading of fear coming into the marketplace, and we should see the S&P start to roll a little bit. But let's take it one step at a time. Let's go right into the charts here. This will be a quick segment, guys. Again, nothing really has changed. I did like to see gold miners, bounce yesterday, and we did get that bounce. Close enough, a little bit lower than where our lower trend line is, but again, as you can see here, we're oversold, and a bullish percent gold miners index was deeply oversold. It had like a reading almost below, almost at zero, if anything, and then we started to roll back up again. So we'll see if this has any legs. Right now, GDX should only be traded for the day. If you're looking to trade it, I wouldn't build a position here. One day does not make a trend or a bottom in the stock, so just keep an eye on it. For a trade, it's actually you could actually probably get some tradable opportunities out of it intraday. Take a look at the spiders. As you can see, I readjusted some of these lines as well. We had some little sideways channels, and we had a bunch of little channels forming within. I cleaned it all up, and I put two big channels in here. As you can see, this is exactly what's happening. We're within the channel, so everything here is telling us that it is bullish. So we don't want to be looking to short the market itself, unless you're trading relative weakness to what the market's doing. Hence some sort of earnings downgrade, earnings miss, something like that is a little different. But when you're looking to short the market in general, I would not be looking to short this market here. We did take back 50% of this candle from the previous day. Now today's anybody's guess, basically wild west here. What's going to happen with non-farm payroll and how they're going to react to the number is really what the trader needs to understand. Not what non-farm payrolls come out. Okay, it's a miss. So if it's a slight miss and the balance of most of the traders and market participants think of it as a miss, big deal, free money still coming, it's not going to matter. So you really want to understand and realize that if it's how the market participants will react to that number, not the number itself. So I would not trade it. I don't trade numbers like that. I wait patiently until the number gets digested into the market, and then we know what type of trend is for the day. Remember, if you're trading for the day, you only have 6.5 hours a day to make trades, so you really don't want to be going against what the trend is, again, unless it is relative weakness or strength to what the market is doing. Here's our 60-minute chart. Nothing has changed, as you can see here. We're still within this range, up in this 156.92, even 157, call it, to 153.65, excuse me. So all we've been doing is literally just shopping around. We are making higher highs and higher lows, indicating to me that we are still in a bullish uptrend. So our indicators have rolled over several times. We did get some market divergence, but after a day or two down, markets continue to pop up again. So there's a continuous bid under the markets. You have to understand that. 30-minute spiders, again, as you can see here, this goes back, I could go back all the way into February. This is how choppy this formation has been. Some stocks are moving, but I choose not to hold stocks in this type of environment, not until we can correct a good 5 to 8%. And then I would look to accumulate stocks that come into some seasonal strength. Right now, it's just a day trading market for me anyway, and that's what I'm looking to do. A little boring sometimes, but nonetheless, if you can continue to just grind out some profits during the day and not overtrade, you will get paid by the end of the month. Here's the here's the S&P cash. Just got some targets in here. 115.55 is acting as was support. Now it's resistance, back at resistance. I'll change that over the weekend. And we do have 15.30 as support. My target still has not changed when the market does correct. And if it corrects at 14.75, that's still going to be a pretty big pivot of support here to see what's going to happen when this does. And I'd love to see it. I mean, we're talking almost 100 S&P points away, but I'd like to see it start to break down this channel, back test it, and then really start to head lower. But again, that time will tell, and it's only going to be if there's some sort of a catalyst. Now, we have market divergence, as we talked about already this week. We have this lower trend line, this uptrend channel, this uptrend trend line, excuse me, that has been breached here, and now here. And now we are back testing this channel a little bit. But look at what happened. We really didn't get anywhere with the transports. Now, the transports are one of the leaders, right? Along with the IWMs, which is the Russell, which gauges risk. And if you look at the Russell, same thing. I took a lot of this little stuff off, guys, and I just cleaned this chart up. And then we have this large uptrend channel. And we have breached the uptrend channel. We caught the 50-day back up. We closed above it yesterday, ever so slightly. Indicators are starting to roll over. This is telling us that markets are starting to lose its luster, lose its momentum to the upside. Risk is coming off. When you have the Dow and the S&P up, and you have our leaders vaguely, ever so slightly, just changing to the upside, and then when the markets do sell off, the leaders sell off in a big way. That's not good. Now, what you could take as a positive is that right now we do have sector rotation, so maybe money might be coming out of the Russell and the transports and coming into other sectors. But when you have sectors still like the healthcare, utilities, consumer staples, still getting money, putting to use in those safe haven sectors, that's also a red flag for me anyway. So we did mention that the other day, and sure enough, we had that big down day on Wednesday. But again, one day doesn't make a trend, so we're going to really need to see some continued follow through. We'll see what happens today. Today will be really interesting, and not really today, but Monday. I'd like to see what really happens on Monday after non-farm payroll day. So it's like an FOMC meeting, you know. They announce it. They announced the FOMC statement. Markets run up. The next day, it just totally reverses course. So really, what's going to happen on Monday, I'm going to be interested to see. All right, here's the XLF, still within this large bearish rising wedge. Wedge is only bearish if it breaks down. We're holding a 50-day, which coincides nicely with this downtrend channel. So we'll just see what happens here. Indicators are rolling over and really unwinding our overbought reading, right? So that's also a positive too. But we'll see. But if the banks and the semis and the Russell and the transports cannot gain any kind of momentum to the upside, the diamonds, which is the Dow Jones right here, as you can see here, is not really going to go too much further. So we'll see. That could reverse, but we'll have to take it one day at a time. These videos are basically trying to keep everybody on the right side of the trade. And if you're looking for something to trade, dial down on one of these sectors, look at the components, and find either the weakest or the strongest stocks, and look for entries during the day. That's how I trade, and that's why I would like to take advantage of these videos that I produce. Okay, Apple. Like I said, only a day trading stock for now. I would not be looking to hold any positions in Apple. Right now, dead money. If it breaks 420, look out below. You're going to get 400, and then back down to that 350, 370 area, and then we'll have to reevaluate then. But right now, Apple needs to do something, say something. What they're doing is not really market really doesn't care. So dead money here. If you're looking to hold it, I would not be holding the stock. Trade it for the day, if you will. But other than that, set off to the sidelines if you're looking to accumulate Apple. And lastly, we have the SMH, and then the Qs did break back up, but we did get good. Let's say about half of the candle, which is not bad. But right now, to me, it's only back test and really needs to prove itself. It's got to get back above this trend line here, and then back above into this uptrend channel. So this is where really needs to prove itself. Right now, this is not a good sign as far as any type of big market rally when you have the semiconductors lose momentum along with the Russell, the IWMs, and the transports, which is the IYT. That's really concerning to me. So this is why I say be very cautious. We can have markets can sell off rather quickly and catch a lot of people by surprise. So if you are holding positions, and I always say I'm a big fan of buying protection, at least you could sleep at night, not worry about it, and ride the storm out. And if not, like I said, if it's just a quick day trade or an overnight hold, fine. You know, not going to be too much damage anyway. No reason to do that if you're holding for a day or two. And lastly, guys, is the Qs. We're still in this uptrend. Uptrend line here from way back when, from November. So we are holding, but we're holding ever so slightly. You have a doji candle here. Again, we'll see what happens today. 8:30, keep an eye, non-farm payroll, trade balance 8:30, consumer confidence at 3 today. That is also a market mover, so use caution if you're holding a position around that 3 o'clock time. But things will start to pick up, and I noticed that things are picking up, which is pretty exciting, and we have been a little bit more active in the trading room. So if you're not in the trading room, sign up. It's for free. It's a good bunch of trade ideas. You know, a lot of guys put out bunch of smart guys in there. All right, guys, have a great day. Enjoy the weekend, and we'll see you on Monday with a big full report. Take care.